Hello, it's Friday the 2nd of February and it's non-farm payrolls. This is a preview. The numbers come out at 1:30 London time, which is 08:30 in New York time, and it's the most important thing on the calendar today as far as the market is concerned. I actually think there are other things going on, but we'll talk about them later. At the moment, the market is expecting a solid gain between 170 and 180,000, and that's kind of the average 3-month rolling average of what's going on at the moment. Healthcare hiring should be the most important source of employment. I think more important than the numbers is going to be the revisions. So watch out that we get a strong headline number, but then there's not really nasty downward revisions to previous months. We've seen that a lot lately. And upward revisions, of course, would be really positive. The wage growth should remain moderate, around 0.3% month on month, and that's obviously key for inflation. So what we have seen as we come into this jobs number is a nasty fall in the dollar, still within a really tricky sideways range, but the biggest drive of this has been bonds. So let's talk about what's going on with bonds and the dollar. So first off, when we started this week, I was looking at this channel that we were in bonds, and potentially this is a very nice three-wave correction, pull back to these daily moving averages, and I was looking for a breakout of this channel and a retest of this resistance at 113. That's pretty important for bonds, because if we zoom out to the weekly here, for the first time we're going to be holding and closing and hopefully holding above this weekly 50 moving average that was such trouble for us when we tried it in April, May last year. And so a breakout higher points to higher. But if I zoom out here, what I think big picture we have done in this 10-year is made a big 5-wave drop, and that normally points to a 3-wave rally. And the most common place that this rally ceases is the bottom of the previous wave 4. So if this is 1, 2, 3, 4, 5, this is the bottom of our wave 4 at 118. And so if we can close above this 236 fib resistance at 113.14, we should head to 118.08 next. That's what I'm looking for. But it's setting up and looking pretty strong. So what is the reason for all this anxiety that is making people buy bonds? We could argue, well, it looks like it's escalating in the Middle East. The US is about to get ready to bomb Iran, which is not good. None of it is good. But there's a lot of stuff going on basically in regional banks and in the banks in the United States linked to commercial real estate. Those chickens are coming home to roost. The KRE regional banking index is down 5.5%, and then 9%, I think, in the last 2 days. That's a big drop. And so this big move higher in bonds has been what is basically driving the dollar lower. There are quite a lot of other things going on in the rest of the world that are pretty weak. The data out of Germany and in Europe is really not good at all. There's been really, really nasty corrections in the Chinese market, connected again to real estate. So whilst the United States stock markets have been a little bit of a bright spot, this may be a little bit of a warning sign that we are going to get a little bit of a pullback in this super strong uptrend in stock indexes. Again, predicting what we're going to do ahead of non-farm payroll, which is such a volatile thing, is the thing. But this 5-wave pattern and 3-wave correction is a really nice setup. In fact, if we look at oil, we can see here, let's go to the daily chart here of oil. We can see a really good example of how this works. So from the high that we made in September this is front month crude oil, US crude. You can say we made a very nice 3-wave correction, and then we had a 5-wave move lower, and then a very nice 3-wave correction. So this was our first swing from this high to low. This was around this 236 fib. Then we had a pullback, and then we had another swing higher. Here's our 3-wave equal measured move, and we went back to the highs of this wave 4. That's very normal. Now, when you measure this, for me, if I measure this swing of the correction, closing and holding under this 61.8 level on a back test, or closing and holding underneath these daily moving averages, would be a bearish reversal. We are right at the point where, if I'm wrong about this being a three-wave correction, we could rally from here. Why would I be wrong? Well, sometimes, this is a wave. This is a wave one, and this is instead being a third leg ABC. This could potentially be wave one of a bigger move higher, and this kind of retrace level is sort of the ideal place to do it from. So if we are going to bomb Iran this weekend, that's what we could see, couldn't it? Let's see. I don't know. I despair about everything that's going on, so I'm certainly not going to make predictions about that. But this is pretty interesting support. If we continue lower here, this confirms this as a bearish pattern. Now, the thing about bearish patterns is, as we can see here, sometimes they turn into bigger ones. So, for example, here we could have three waves up. We could make three waves back here, and then we could see another bigger one to finish. So, this is just short-term swings until something bigger establishes, but this is a really good example of that pattern that we're talking about. And when we look at this is quite important, because exactly, we could see the same pattern here in bonds, and that would take us back to 118. So this move higher in bonds has caused quite a swing in the dollar. Let's take a look. The dollar's been so tricky when we think about it, the last 10 days, in this really choppy sideways range of indecision. But we could also argue here in the dollar, this was 1, 2, 3, 4, 5, and we've got 1, 2, 3. Didn't quite get back to that 50% range, but this is really flat daily moving averages, indecision, and we are still stuck in a really nasty sideways range. For me, there are a few. I think that commodity currencies are a really good leading indicator of which way next. And if we look at where we are in this Aussie dollar, from this low to high, we're holding a very nice 50% back. We could also argue in this Aussie dollar that from the low in October of 2023, we made 5 waves up, and we have potentially done very nice 3-wave back. And here we are basing for another swing higher in the Aussie dollar. I'm kind of leaning towards that. And also, if we look at this is a false breakdown. So we made a low, we went sideways, and then a false breakdown retest of this low. That's pretty bullish. So back above these highs would give us the first target back to this daily 50 moving average at that famous 0.666 number, and above 0.666. I think we're another swing higher in the Aussie dollar after a bigger, potentially 3-wave correction. Commodities tend to make these 3-wave moves a lot, so do commodity currencies, and so on. So that's how we're looking for me ahead of non-farm payroll. We're looking for a strong jug number. Watch out for the revisions, but really we should be keeping an eye on a bond market and stress in the banking sector from commercial real estate. That seems to me what seems to be driving the move in the dollar, and we should prepare for this weekend and see what comes. Good luck.